What we know is a drop. What we don't know is the ocean.
Hello and welcome to the Newton Knowledge Podcast. My name is Mark Singer, partner of Newton One Advisors, and I'm joined by our managing partner, Steve Target. The Newton Knowledge Podcast will provide meaningful content to our valued advisor community. Our discussions will deliver unique insights into the people, processes, and products that make our industry so critical. Newton One is a national life insurance planning firm delivering customized solutions structured to help clients and their advisors engaged in solving estate planning, wealth transfer, business succession, and executive benefits challenges. We are a member of the M Financial Group, which grants our clients access to the nation's elite carriers and exclusive products available only through our network.
I could tolerate any insurance seminar. For days, I could sit there and listen to them go on and on with a big smile on my face. I'd say, how can you stand it?
How large was the GRAT? How large was
700. It was funded with $721 million.
It's a decent size, huh, Steve?
It's pretty good.
Yeah.
688, and the payments due were 721.
Okay. Well, with that number, let's kick it off. Today, we're diving into a topic that gets a lot of attention in the estate planning world: GRATs, grantor retained annuity trusts, and a major tax court case. I wanted to ask this before. Is Elcan?
Elcan.
Elcan?
I'm not sure we know yet, but yeah.
I call it Elcan, and that's what I did a little video on it. So
I trust you, George. We're going to do Elcan. Yeah, Elcan versus Commissioner. This case, and we can't stress this enough, it's in its preliminary stages, has the potential to reshape how advisors think about GRAT administration, particularly around substitution powers and annuity payments. To help us unpack this, we're joined by George Riter, senior partner at Timoney Knox, who brings deep experience in estate and tax planning. George, thank you for being with us today and hosting us in your office.
Thanks for having us. We're glad to have you here.
Tell us about your career path first, becoming a senior partner at Timoney Knox and the resources the firm provides, and then go into your particular practice as well.
I actually was a bio major in college, thinking I'd go to med school, but organic kind of swayed me away from that. So a good friend of the family, was a lawyer, so I followed that path. When I got out of law school, graduated from law school, I started with a small firm downtown, did mostly trust and estate work. And then in 2001, Tom Timoney, who was one of the named partners who I'd known all my life, convinced me to come out here, and so I've been here ever since. And we're essentially a general practice firm in the fact that the largest group is trust and estate and corporate and tax. We have a strong litigation. We do municipal. We do real estate. We don't do securities. We do very little private equity, but otherwise we can serve most of the needs of our clients.
And yours is particularly estate planning, trust and estate. Okay. Did you go into the legal world knowing you were going to be an estate planning attorney?
Good question. There's so many areas of law, and you think, okay, what do I want to do? It turned out that the firm I started with, that ultimately when I left was Davis, Riter, Perry, and Hartman, was essentially a trust and estate group with some litigation, insurance, defense. And I just realized that dealing with families, multi-generations, partnerships, real estate, tax, estate documents, you're really doing so many more things. And becoming a family advisor was really, it's what I like about all this.
This interests me so much because when you look at some of the and by larger, 400 or 500 partner firms, whether in wherever across the nation, does it tend to have a smaller estate planning practice with everything you just mentioned in terms of all the other opportunities to deal in practicing and assisting your clients? They tend to be a smaller form of the overall firm.
Mark, if you look at the historical management of some of these firms, some of the big ones, the Deckards, the Ballards, the Stradleys, they were run by the head of the trust and estate department for years. And for years also, the methodology was, okay, we'll just do the documents, and then hopefully if we get the estate, that's where we'll make the money. And over time, it's shifted. We're just as much driven by business as the litigation group or any other group here. And so some of them migrated. Some of the groups that are out there, our competitors, who I consider them friendly competitors, left the large firm environment because they realized that they could do it on their own. They could do it for cost effectively and make money. Yeah. And now the large firms keep a small presence because they feel like they have to serve some of their clients. Some of them are legacy, but it's a challenge to do this, and it doesn't have quite the appeal of M&A and the corporate attack. And if you're representing a merger and acquisition like two airlines joining or whatever, that's much more exciting than trust and estate.
George, I've got two things. One, just you're such a professional. You're so smart in this field. But one of the things that really makes you great in this marketplace and your profession is the ability to use something like what's right in front of you there, the yellow pad. You take very, very sophisticated ideas and strategies, and you can translate those down into concepts that anybody can understand. And that's really a talent. So my follow-up question to that is, at the dinner table when the kids were growing up, did you talk about islets and slats and GRATs and idiots, and how did you raise a young man to be in the estate planning world?
We did not talk about that, and my wife would not allow me to talk about that. But as they got older, we talked about the fact that I can't mention my clients, but they maybe have driven home by somebody, and somebody says, "Oh, we were just with your dad today." And next thing you know, they realize that some of my clients were dear friends. I mean, I am blessed to have incredibly terrific clients. A lot of them are friends. Not all friends are clients, and that's fine. But it did turn into that topic when George, my son, got out of law school and then went to NYU for his LLM. And during COVID, it bored the heck out of the rest of the family.
Yeah. Considering this case, can we begin with the basics on what a GRAT is and why is this case getting so much attention?
GRAT stands for Grantor Retained Annuity Trust, and it's permitted under the IRS Code, Section 2702. And the key is, and what makes it so efficient and unique and quite frankly versatile, is the fact that if done properly, a person that's known as the grantor can transfer funds into this GRAT, this trust, which is irrevocable, and usually for a term of years. You often hear about 2-year GRATs, 3-year GRATs, whatever, but they're zeroed out. So what you can do is, what that means is you can transfer money, let's say $1 million, and you would transfer primarily securities or assets that you think would appreciate. And the grantor gets repaid over the term of that trust. And the thing is, it doesn't use any of your gift tax, the way it's usually structured. Yeah. So think of it more as a loan that will come back to you and hopefully appreciate. The other but it has to be administered properly. All too often, somebody will draft a GRAT, and you got to be particular. When does it go in? What goes in? How is it valued? What are the key dates? What are the key reporting periods? And sometimes that's where, for lack of a better word, the wheels start to fall off.
So as we're sitting here today, we're referencing a case, the Elcan case. What is the IRS challenging in this particular fact pattern?
Well, first, with not any disrespect to the IRS, but right now they're understaffed. So normally, if you file a gift tax return for a gift directly to anybody, to a trust or a GRAT, they look at it and probably just passes through and gets accepted without review because it just looks good on its face. I mean, this is a very significant. The Elcan family they created 3 GRATs, and they transferred an aggregate of $688 million into these GRATs. And the annuity payments to come out, which is the amount the trust had to repay, was going to total about $721 million. So first and foremost, you've got significant GRATs that are not the norm, and they're going to look at it more carefully. Yeah. What we were talking about earlier is it's in its beginning stages, and normally going in, they would be looking at the assets and how they are valued. Was there appraisals? Was it fully supported? And here, though, they're saying that we're going to look at the fact that there was, as we'll probably get to, they changed assets, and and I don't know why the IRS is revisiting that issue, but that's the focus point. They're claiming that the assets that went in, which were S corp and real estate units that came out, and then they were substituted with promissory notes issued by the grantor. So I create a GRAT. I'm the grantor. I then put in, some stock, and then later on I pull that stock out and replace it with notes of equal value. It's called a swap. And it appears from what you can read that they didn't value those notes, that there was no supporting documentation. So the IRS is claiming that either they were not of equal value or they were worth more, and therefore it was an addition and a gift. So that's what they're focusing on.
Interesting. So let's talk a little bit about, it seems like one of the questions out there is what's considered a qualified interest, or what is considered qualified interest under IRC 2702, and how might taxpayers and the IRS interpret this?
The key section is 2702, and it basically says that they have a defined calculable interest. And so you have to identify what are they getting. So the assets go in, and they look at the tax rate. It's called the 7520 rate. And they look at, it's a published rate, it changes monthly. And you have to put money, you put the asset in, and then normally to zero it out, it's going to pay back, the trust pays back the grantor a different percentage each year. It's usually 120%, and it's paid over the course or term of the trust. And it's got to be, the note has to be identifiable, the rate has to be identifiable, and you have to make sure you're clear and unambiguous on what's going in. The qualified interest is that you can clearly identify, this is the focal point, what is the grantor getting back over the term of the trust? There are three main points, but that's the key. And one of the what makes these trusts attractive is this swap, as you alluded to earlier, Mark, so that if you put in assets, let's say you put a variety of stocks, or you put shares of a closely held company, get it valued. Stocks are pretty easy to value if they're on the market. Businesses, you need to get valued. Mm-hmm. And then you have to attach that to the gift tax return. And then later, if that's going up, let's assume it's going up in value and you want to lock in some of those gains, you may swap out other assets. We usually don't recommend using a promissory note because it is a little bit more scrutinized by the service, and you've got to get it valued. And how do you value it? But you can lock in gains and you can manage it, but it has to be identifiable. And if you start running afoul of those rules, that's when you get into trouble.
Yeah. What do you recommend doing if you're not utilizing a promissory note?
We've used promissory notes, but never for the whole amount of the GRAT.
And that's what happened.
Here, they just, in my words, where they flushed out all the assets and then put in this note without, from what I can gather, again, I've looked at the docket, it's in preliminary stages, there are preliminary objections, motions for summary judgment, but it appears as though the service is focusing on, one, were these notes of equal value? And if they weren't, then you violated the swap requirement that it has to be of equal value. Or the alternative, that maybe they were worth more, and therefore they put in assets of value greater than what they took out. And so that's an additional gift, and you cannot add assets to a GRAT. Once it's funded, it's funded. So what we recommend, and what we've done a couple times, and it's been pretty effective, we identify what does the client hold? What can the client afford to transfer? So let's assume for a moment they can transfer $5 million to a GRAT. And depending on the market, and I'm not a market specialist, but we'll do 2-year GRATs, but we've done 3, 4, and 5-year GRATs, knowing that we can swap out. And so we transfer the assets in, identify when we put it in, and then we monitor it. And if we've had a couple situations where the stock market has been favorable, as we all know, the values are higher. We then want to lock in the gain, so we may swap out other assets. We may put in some fixed income or cash or a note, but never for the full amount.
Yeah.
And the note we have valued by an accountant or some other qualified professional.
So as you think about this particular case, does this change the way you might approach GRATs moving forward, or is it kind of business as usual until everything flushes through the system here and there's some definitive?
Good question. For us, it will be business as usual because we don't push the envelope. I would say we're conservatively aggressive. We may use notes periodically. We may use S corporate stock that we have to value. We may use, think about it. If you can transfer assets into a trust, have it valued, and you believe there might be a liquidating event during the term of the GRAT, then that's going to be hopefully a productive result. Here, it appears as though they did not get the valuation, so they didn't understand. Let me back up. They could not determine what was the value of the notes going in. Were they supportable? So think about going to a bank and they loan you, $100,000, and they just say, just sign this note, and you haven't pledged anything. Well, if they don't know what you have, then is it supportable? Can you afford it? That appears what it seems to be what happened here. Yeah. So for us, our clients don't want to become a test case. And we would be a little bit more conservative, but there are tons of firms, we were talking earlier about, larger firms that have, larger GRATs, although these are really significant. And I think most people would believe that. And they do notes all the time, but they do get them valued.
Yeah. Let's talk about valuation. No valuation is not good.
Correct.
One valuation is probably enough.
Correct.
Are there circumstances where you have more than one valuation? Does that help build the validity of the transaction?
We have never obtained more than one. But if we did a GRAT where we transferred money to an irrevocable trust, it doesn't even have to be a normal trust, not a GRAT. You're going to attach a valuation. Right. If the IRS comes back and says, we believe you've taken an unreasonably high, I use the word adjustment rather than discount. Yeah. So if you have if you're giving hypothetically a third of a piece of property away, and that property is worth $1 million, that third is not worth $333,000. It might be worth that less, 25, 30, 35, 33%.
Yeah.
And then you have a supporting operating agreement. But it's that type of thing. Now, if the IRS challenges it, then we get another valuation, and they usually get their own.
To recap, do you believe this, for the three reasons this case is under scrutiny, is one, the size, $700 million GRAT.
Absolutely.
Two, the valuation or lack thereof, not
Yes.
understanding. And then three being the total promissory note swap for all assets.
Yes. And another one that the IRS seems to identify, and that is that the grantor created the GRAT, transferred normal assets, company and other identifiable, I'll call them hard tangible assets, and then unilaterally took out notes that they issued. So they felt it looks as though it's self-serving and not really separate. There's not a separation. There are a lot of trusts that don't have corporate fiduciaries. But if you're going to do this, you have to make sure that you document. And you don't want the grantor, who's not supposed to be, self-dealing, do activities that give that appearance. So that's the other piece to this case that is looming, pretty large.
Coming from the insurance world where we are there any opportunities to have insurance participate to maybe protect some of the exposure or to enhance this strategy in some form?
Well, we've talked about this before, and I'm not sure on a GRAT level, but in a trust level, absolutely. And you can create a trust that kind of mirrors and sounds like a GRAT, but doesn't have the same zeroed out, so to speak. So, we've been involved in a case where we had the assets. We created irrevocable trust for children, obtained significant life insurance on a parent, And then the parent, through a trust, loaned money, much more than we needed. And the initial value of that loan was $10 million. And the insurance is $10 million, and the premiums will be about $300 and almost $400,000 at the end of the day over 9 years. Well, the investments in that trust now are over $17 million. So that we have insurance that will be added to that and pay to that. So all the appreciation and all the life insurance is completely out of the client's estate with zero tax implications.
It's magic.
So that's, there are ways to use it, and they're not necessarily cutting edge. They're a little bit out of the box. They're a little bit normal. They're a little bit unusual. But if you have the right client with the right assets and the right advisors, one thing clients like is the fact that you guys don't pressure them, and you're there as a team, because the best way we can serve the client is by not being silos. I am an advocate of client meetings, family meetings, where you have the investment advisor, the accountant, someone who has the insurance under management, and normally us. And we probably down to 15 to 20 of those a year for clients. And it's really best for all of us, and ultimately best for the client.
Yeah, no doubt.
I couldn't agree more. Collaboration is key.
It is really, because we can't think of, we can bring our experiences and our background, but collaborating is really effective.
Well, we challenge each other.
Yeah, and it's a healthy challenge.
Absolutely, yeah.
Since this hasn't been argued yet, what decision, if in favor of the IRS, how could that affect GRATs ongoing, GRAT planning?
GRATs began to become under pressure around the Obama administration. They thought of extending it to a minimum of 10 years, having a minimum 10% as a taxable gift. And I don't think there's going to be anything's going to happen during this administration because of their tax policies, and that's fine. That's good for our clients. But it's going to be reviewed at some point, because essentially it's a technique that it favors the more fortunate and clients that have the ability to have good advisors. So it wouldn't surprise me if they put some parameters on it. And I will tell you, working with one family in particular, they're accountants. It's a big accounting firm, and they tend to be conservative. They insisted that instead of not just putting assets, mutual funds, and stocks, they wanted a minimum of 10% cash, so that there was some liquidity in there, so that when it had to pay the annuity, it wasn't all coming back from the assets in the trust, the non-cash assets.
Yeah.
So it's getting a little more conservative in the administration.
We're coming up on our time. Is there anything we didn't touch on that you wanna talk about, George?
GRATs are still a great technique. The interest rates have crept up a little bit. The market's a little frothy, but if you do them, maybe not 2 years, maybe you do them 3 or 4, or you do a series of them and fund them differently. Maybe you put more of a mutual fund in one and individual stocks in another, but it's a great technique. You've got to advise the clients of the downside, but if they hit, it is so effective, and the money ultimately comes back. So you're not really getting out of their estates as far as the appreciation, but it's more like a lending, and clients like that, especially with the exemption so high.
Thank you.
Bye. Goodbye.
The material and opinions voiced are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine what is appropriate for you, please contact a member of our team.